Welcome to Peerpoint Perspectives, the Securities Finance podcast delivering commentary from the best, brightest and most innovative people in the world of securities lending, repo, collateral management and related areas. Peerpoint Perspectives is brought to you by the consulting team at Peerpoint Financial. So now, over to your hosts.
Hello and welcome to episode 2 of Peerpoint Perspectives. I'm your host, Roy Zimmerhansl, and practice lead at Peerpoint. This is the first of a 2-part episode about relationships, and I have 2 of my Peerpoint partners joining me to talk about all things relationship. Don't worry, you're not listening to some reality TV program, but just as with any relationship, both parties want something from the other side. In this case, a happy relationship is one that is not only profitable for both, but also where the lenders and borrowers feel secure and confident in each other. It's really 2 sides of the same coin. In today's segment, we will examine what securities lenders and their agents want from borrowers. And in part 2, a separate podcast, we'll explore what borrowers want from the lenders. As mentioned, joining me today are 2 of my Peerpoint partners, both with many years' experience in the business. So without further ado, let me welcome my first guest, who has been involved directly in securities lending for almost 30 years. He has run the securities lending businesses for an American agent lender and an ICSD, and has also been global head of agency lending business for a French bank, with additional experience as a consultant for a data vendor. It's John Arnesen, consulting lead at Peerpoint. Heading up our Benelux practice is my second guest, who has 20 years under his belt in securities finance gained at firms across 3 of the key segments. He set up a securities lending program for a major European asset manager, ran the trading desk at a top 10 global custodian, and has been responsible for sales and marketing at a global broker-dealer in London. He's seen all sides of the business, and that's really valuable for understanding what each side of the equation wants from the other. Let me welcome Jeroen Bakker.
You're welcome.
Good morning, John. Good morning, Roy. Thank you.
Hey, guys. Look, in segment 1, as I said, we're going to be looking at the lending side first. So I'll be turning to John. You know, John, the thing is, at first glance, it doesn't seem to be that difficult to question. Lenders and their agents obviously want the same thing. They want banks and broker-dealers that will take a lot of stock and pay well for those assets. Is it that simple?
On the face of it, it is that simple, but there's lots of moving parts that go into getting yourself into a position where you are ready to lend to a universe of borrowers that you've selected. Firstly, an agent lender represents a number of underlying beneficial owners, and the step 1, in my opinion, would be that you have to have a very good look at yourself in determining what size of agent lender are you. Do you have huge amounts of assets that need to be mobilized, and therefore which borrowers are going to be the ones that will take huge amounts of supply? It may be that you consider yourself somewhere in the middle of the universe of agents, given there are many, and that you'll have to differentiate yourself in a way that isn't necessarily that obvious about moving your assets, because the very large agents above you have already forged relationships with the very largest borrowers. And thirdly, you may determine that you're actually quite a small player, in which case you'll have to differentiate yourself in a way that is maybe not that obvious. It could be that your supply is niche. You may have an asset class which is in great demand, and you happen to have a weighting towards that asset class, and therefore you need to seek out a way to mobilize those assets and compete. Because at the heart of this, Roy, is that you're always in competition in a very competitive market.
Yeah, John, that's actually an interesting point. You know, it reminded me while you were talking about it, when I used to do training programs, so we're still doing training programs today, but when I was doing them, I guess between 2010 and 2013, the case study I would do at my introductory course was exactly that. I would give the students 3 scenarios. You were a big lender, you were a medium lender, or you were a small lender. And the challenge for each of them was how do you make yourself attractive to your counterparties? Or in the case where you were a big lender, did you even need to? Was it more a case of how did borrowers make themselves attractive to you? So it's interesting that you bring that out.
I mean, the question you asked me is, what does an agent look for from a borrower? And it really is. It's so much more of a mutually beneficial relationship than it was perhaps going back into the 90s and early 2000s. In the early 2000s, you had a massive upswing in demand through the growth in hedge funds. But it's now smoothed out to the point whereby, as one of our former colleagues has said, who's the client in this relationship? And I think you have to kind of conclude that agents have clients on their side, which they are mandated to generate revenue on a sort of risk-adjusted basis. But the demand side is the driver, because all the supply in the world is chasing a limited amount of demand. And you only have to look at one of the vendors that amalgamate the activity to see where you stand in the universe. There is an oversupply of almost every asset class. Therefore, the demand is finite. How do you gain market share in your approach? So it is sensible for agents to consider the borrower, the client, and how do I make myself relevant to them?
Yeah, it's funny you say it in that way. I will tell you, my last bank, I spent a lot of time arguing with my compliance people in the end, which I won the argument, fortunately. But the issue that I was talking to them about or debating about or had a different view from them on was they said that the borrowers were legally our clients, and therefore if I got a higher than average fee from them, I had a duty to actually re-rate. I went, no. I have real legal obligations to my underlying beneficial owner, and it's my job to get as much as I can from the borrower without damaging the relationship so that it becomes sort of an ongoing mutually beneficial relationship. But can you give me, before we go into more of those issues on how lenders might differentiate themselves, can you give me some examples on the kinds of things you'd be asking borrowers about? Like, how do you determine in the first instance whether they fit into your program or not?
First thing I would look at is the borrower offering prime brokerage services to their underlying clients? Because I know that's going to generate consistent demand throughout the year. And that's the first point of call I'm going to be looking at. However, everybody else has the same idea, and they also have a range of options in terms of how they can source supply. So therefore, I'm going to work out a relationship with each of the largest prime brokers, and essentially forge a relationship whereby my distribution to them is done with the highest degree of automation. So I'm going to be asking them a number of questions about that in terms of, are they going to be utilizing a platform on which we can trade? I'm going to want to know, particularly now, about their SFTR reporting capabilities, and are we going to have any issues on that? Because clearly that's something that's going to be affecting us going forward. And you don't want to have to do a lot of post-trade reconciliation if they are somehow weak at doing that. The other thing I'm going to want to really look for in any borrowing relationship is a balance between fixed and equity demand. Ideally, you have both in a healthy way, where you can trade a lot of your assets to a single counterparty in that sense. But I'm not necessarily wedded to that. For example, I used to actually seek out, in my last role, I used to seek out non-prime brokers because I knew there was demand there, and they were quite open about the fact that they're not going to have the huge demand that I could do elsewhere. But what did they want? Well, they certainly wanted fixed income in terms of high quality liquid assets, because they had regulatory concerns, well, not concerns, they had regulatory obligations. And I used to do a lot of HQLA type of activity with non-PBs. And what's interesting about all of this process, Roy, is I haven't mentioned fees at all, because I think the fee negotiation is probably the last thing I need to be putting in place. Obviously, if we can't agree on fee, then we're not going to ever trade. But I don't think many people are haggling at the forefront of every transaction about the fee. It's, do I have a seamless process? Are you going to be consistently there for me? Are you going to be returning me assets to me quickly? Or do I see a nice long duration? And a number of other post-trade things, which we can come on to in a minute.
Okay, that's good. You know, I'm wondering, Jeroen, John's talked about a couple of things here that where when evaluating a borrower relationship, he looks for a couple of things. And I know we'll touch on these in the second segment, but does anything on the automation or the fee side of things grab your attention, or maybe something else?
Yeah, sure, Roy. Well, let me start by saying what you were talking about in relationships between borrowers and lenders. One of the things indeed is transparency. That's key. I can still remember the people that were, how should I say this, less transparent over the 20 years that I've done business with. And you will always keep this in mind. This is a people's business, and it will always be a people's business. Coming to on the fee side that John was mentioning, I think you're right. Fees are important, but there's a price to anything. But if the price works, it will work. More important is, can we trade? Can we trade easily? Is it flexible? Can we manage to put the trades on the book? Are the traders happy with the relationship they were dealing with? So that definitely comes to your point in relation to automation and platforms. I would say traders are by definition a bit lazy, if I may say so. So if they can put something on the book that takes them 2 minutes to do the trade, they will have that preferred to do it to putting it on 10 minutes to put the trade on the book. So yes, that definitely makes sense. And just going back to what John said earlier as well, is that diversify your pool of borrowers. For borrowers, it's important not to have all your eggs in one basket when you're trading, because you want to avoid yourself in a situation that you get recalled on your entire position. The other way goes for lenders as well. They want to safeguard themselves against return of big balances. So if they have only a limited amount of borrowers, or only a few amount of borrowers where a certain stock is outstanding, they jeopardize themselves for large returns, i.e. also a huge drop in revenue.
Right, thanks. So John, you talked a minute ago a little bit about how one of the differentiators would be the amount of equity versus fixed income business that a borrower would do, and you might have balanced relationships, or you might have one that's skewed more towards equities or fixed income and bring that together. Can you give us some other examples of the business drivers that you'd use to differentiate amongst borrowers?
Sure. On the last point, though, if I could, Jeroen, I had a question for you, as given that you have been a borrower. Do borrowers, regardless of credit limits that agents put on borrowers, either from their underlying beneficial owners or at the bank level, do borrowers equally limit the business they're prepared to do with each agent lender?
Yes and no. Yes, in the fact that they have a soft limit that they will say, I would not lend, or I would not borrow more than an X amount of volume from this particular agent lender. No, in the sense that the actual risk parameters are set to the beneficial owner. So those are the risks that are set in stone, and if you breach those, then you have a problem internally. So it's a yes and no answer, John.
Interesting, because it goes to your point about not being suddenly pulled on a huge amount of supply and having that sort of shock to your balances rather than a credit issue. So in other words, an even distribution means you're more likely not to suffer that.
Correct.
Roy, back to your question. The establishment of any relationship is quite burdensome. And it starts with the actual onboarding and approval of your underlying clients to that borrower. We've all had to do it. And I can tell you that I think the world record that I ever set was 18 months for the borrower to actually approve some of my underlying clients. And it was incredibly frustrating to do that. So the first thing I'm going to look at is, what is their process like what is their approval process like? How quickly can they do that? And also, are they going to be very particular about receiving documentation from me? I used to have a number of central banks in my lending pool, and I used to have a number of, shall we say, certain continental European countries have to have documentation from every one of my clients. Well, good luck trying to get documentation from a central bank. You either approve them or you don't. And I actually had a problem where they wouldn't approve certain central banks with great HQLA assets because they couldn't document them. So I'm going to look to avoid that situation at every turn. I've mentioned that a high degree of automated trading is important. Also, the way that the borrower is prepared to communicate with me. Am I going to be one of dozens of Bloomberg messages every morning that every other agent is sent at the same time? Or do we have a more structured approach to how we're going to communicate demand and supply? If there is one, I'm interested to hear it, because otherwise I know that my traders are just one of many, and they're not making a differentiation, and therefore my assets should be. I have to then determine, who's going to receive the supply. Is it the fastest response, which I don't think is necessarily that useful. Collateral is obviously important to a borrower, and I'm aware of that. And equally, I don't necessarily want to have endless conversations about, if I could accept X, Y, and Z, how much more business we could do, because we've all been there too, where I've had to go back to some very key lenders and say, can you accept this form of equity collateral, because our business will actually exponentially improve with these 3, 4, or 5 borrowers. If I'm having that conversation with my clients, I want it to actually materialize in real business. And I've had examples where I've done just that, and it's a mixed bag in that some definitely improved our business. We took a huge amount of equity collateral, and the clients were very, very happy with it. But it's equally backfired on me, where I saw no determinable increase in business. And the client was saying, look, I had to get certain approvals to do this, and I'm not seeing it. So I'm going to be very wary of that. In other words, I'm asking borrowers to really mean it when they push to accept, clearly what they're trying to do is have me accept their long balances, which I understand perfectly, but it's got to be demonstrated in a material way. Next year, we're going to see a new regulation, the Central Securities Depository Regulation, that requires the whole of the capital markets in Europe to have far better settlement processing, to the point whereby if it doesn't happen, and after a certain period of time in a failed transaction, there will be buy-in penalties, which have to be executed on the two counterparties involved. Securities lending can exacerbate that problem, because obviously stock is out on loan, and if a client is selling and you fail to return it to them, you've actually put them into a position where they have a material cost. The settlement failure in securities lending is real. It is incredibly important to an agent that it doesn't happen, because it's a reputational risk for you and your clients. Bearing in mind, you've probably sold the entire business on the basis that it is behind the scenes, it does not interfere with the investment management process. But a failed transaction immediately highlights to your client that there can be issues. I'm going to monitor failure rates with each borrower, and if I see that there is a duration of failure that extends beyond, let's say, 1 or 2 days, because I understand why that can happen, I'm going to certainly take that into my consideration of how much business I'll do with a borrower that is particularly bad at failing back to me. And secondly, if I don't feel that they are making the effort that is required, being sensitive to my needs.
So, John, I guess, would it be fair to say the same thing in a different way, that operational issues happen, mistakes can arise, you're willing to forgive a mistake? Replication of it, though, actually isn't a mistake, it's a pattern. And even if your customer can recover the economic impact of a fail or a buy-in, they can't necessarily remediate the reputational issues.
Absolutely not. And let me tell you a quick story. Many years ago, I was on an annual review with a client, not in Europe, and we did a huge amount of US government lending for them because that was the majority of their holdings. The revenue generation for this client was in the tens of millions. And during this meeting, the client turned around and said, I see that you failed on 2 transactions recently, and I want to know what happened. And it was a one-day fail. My boss at the time said, yeah, I'm sorry, it was a technical issue with the borrower. And the client leaned across the table and said, if this ever happens again, I will close the program. I cannot fail to my counterparty because of you. And it was a real wake-up call to us. And strangely enough, we never failed back to that client ever again. He was prepared to leave tens of millions of dollars on the table for his reputational risk issues, or the avoidance of them.
Okay, a salutary lesson for us all. So, Jeroen, on the borrowing side of that, do you feel that kind of pressure when you're recalled, or is it more, I'll get around to it when I can?
No, it's definitely pressure, because we also know what the agent lender has on the back of it. So if we continue to fail to the agent lender, at a certain point, the agent lender is going to turn around and say, I'm not going to do business with you anymore. And that will dry up inventory for us, which is the utmost thing we want to avoid.
Well, okay. So I guess it's clear now. Right now, it's more of a relationship thing. But as John said, when CSDR comes in, it will be forced on everyone. So settlement efficiencies hopefully won't improve because they'll be good enough that there won't be any impact from potential buy-ins, but we never know. So John, you've talked to us about a number of different criteria, but this is a relationship conversation. So what about relationship reviews and performance?
Clearly, they're important to conduct. Both parties need to know where they stand with each other. And interestingly enough, when I have performed those in the past, the actual trading aspect of it in terms of the balances and the fees were probably not high on the list of things that we wanted to review. Post-trade services really shouldn't be called post-trade. It is one continuous transaction during the life cycle of a loan. And if those transactions, for example, I just mentioned recalls, very high on the list of things I want to check. I also want to check things like, are you paying manufactured coupons and dividends on the pay date? We all know, we've all experienced high levels of uncollected or unpaid manufactured dividends and coupons, and it's unacceptable. Because it's quite clear that you know the paydate's coming, or you know the due date is coming on the equity, and for some reason, historically, it's just been left to sort of languish with millions and millions of dollars or euros worth of uncollected or unpaid coupons and dividends, and that's going to be again high on my list. Also, I want to understand what's the driver of the reason why it's being paid late. The same thing applies to billing, which we all know is cut at the end of the month as a snapshot. I want to know that that is also paid to me on time. And the way I do that is ensure that my counterparty is using a vendor's post-trade services. So our transactions are always matched and kept matched throughout its life cycle. That's going to be forced on the market to some extent through, and you're going to tell me not to use the acronym, but I can't think what SFTR stands for at the moment because it's too early. But you'll help me out, Roy. That's going to force the market to match on a daily basis, and I don't expect it to be particularly good when we start this in July. But by the end of the year, I think you'll see a high degree of matching, which will improve those things exponentially anyway. So I expect the reviews you have with your borrowers in the future, some of these issues which are important and niggling may actually go away.
Right. So, John, it sounds to me like there's quite a lot of things that would go into a review and possibly would be best left to maybe a separate podcast where we go through what a review might look like. By the way, that SFTR is the Securities Finance Transactions Regulation, Reporting Regulation. So Securities Finance Transactions Reporting Regulation, SFTR.
And I did know that. It's just too early on a Friday morning.
Yeah. Okay, great. So John, really, I guess the kinds of things that I'm hearing from you is that in our hunt for an ideal borrower, we're going to be left stranded, I think, because it doesn't sound like there is one. So in the absence of a definition, what would you say are the three most important things that a lender is looking for in a borrower?
Is my balance to each individual borrower from most of my clients in a relatively good distribution pattern? Is it stable? And is the duration of my loans acceptable? Of course, I'm going to get returned. I get that. But I'm looking to do business on a long-term annual basis and on an annuity type basis. First thing I'm going to look for. Operational efficiency is going to be the second thing. And I think operational efficiency has to be at the forefront of every trader's mind, in that there's no point in me doing business with this borrower if I have a whole heap of unreconciled or issues with the loans. In terms of supporting them, in terms of marking them to market. And if I have problems with that, you're actually probably doing yourself a disservice and that of your client. You're right, there is no perfect borrower, but those are the sort of statistical factors that take out the emotion of the relationship. And I'm just going to look at it on that basis. And I think it actually does work that way, because clearly this is a market with 2 trillion of assets outstanding, and it seems to be not flat. It seems to be that there's potential for the growth in the business, but you can't grow this business without far more automation in supporting that. And as I've mentioned, regulation is going to be dictating some of that to us. But in the meantime, that's really the highlight of the high on my list of what I expect from a borrower.
Thanks for that, John. It sounds to me like a few of those issues could be podcasts on their own. I think that's a good spot to end this first segment, and that's a wrap for this podcast, where John and Jeroen took us through some of the key elements of what lenders look for from borrowers. Remember, we want to provide you with topics that you want to hear about, so if you have subjects you want to learn more about, or guests you'd like us to interview, send them through to us. Our contact details will be in the show notes. In part 2 of this episode, we'll dig into what borrowers want from lenders, so join John, Jeroen, and me next time. If you want to hear more from us, please subscribe to the podcast and tell your friends. You can find us at www.pierpoint.info. We're on LinkedIn and Facebook as Pierpoint Financial Consulting, and on Twitter at PierpointFC. Again, I'll leave all of these links in the description. I'm Roy Zimmerhansl, and I look forward to catching you next time.